Okay, well, I make it just gone 11 o'clock, so let's get started. Good morning to everybody, and thank you for joining us at our webinar this morning, which is all about some of the business challenges we face heading out of lockdown. We've really put this together as a result of the government's roadmap for businesses out of lockdown, and hopefully we'll cover a number of points and potential challenges that you're facing as business owners at the moment. I'd like to introduce you to Paresh Radia, a partner here at RDP Newmans, who's going to deliver the content for us this morning. So good morning. And we will have time, hopefully, at the end of the session today to take some questions from you. On your Zoom toolbar, you'll find the Q&A option. So if you'd like to put any questions forward as we go along through the webinar this morning, please use that tool to put your questions in. And I'll come back at the end and we'll try and answer as many live as we possibly can. We are also recording this webinar, so we'll make an on-demand version available if you do need to recap on any of the points that we've covered. So at this point, I'll hand over to you, Paresh, and I'll see you back at the end for the question session.
Thank you. Good morning, everyone. Welcome to our webinar on the business challenges as we head out of lockdown. We're going to cover sort of key four aspects this morning. Managing cash, cash flow forecasting, pricing, and business finance options. There are many other aspects that may be relevant to other businesses, but I think these four are worth focusing on this morning. So, looking at the managing the cash of a business, this is one of the most important aspects of a business, because if you manage your cash well, you will avoid working capital problems, you will identify cash requirements for investment and growth, and particularly in this time that we find ourselves now, as we come out of lockdown, cash is going to be a very important factor in trying to get the businesses back to where they were compared to pre-COVID times. Some of the must-haves in the managing of cash is know your numbers. You must have access to good data from your businesses so that you can identify trends and the causes of any cash shortfalls and be able to react appropriately to any scenarios which are going to cause concern to the business and their cash flow. It is very important, again, to set out a budget for your business, at least annually. It allows you to forecast forward from a starting point of what you expect your business to achieve and the cash flow requirements. You can compare your budgets to actual situations. And if you find that there are any significant variances from what your budget highlighted as the expectation to the end sort of situation, you can again have the opportunity to review your budgets and cash flow forecast to decide where the issues have arisen and how you are going to react to them. In managing cash, it is very important also to build in an element of flexibility. It's not wise to budget to the last £5 in your sort of cash management. You must have buffers within your cash flow to ensure that you manage to deal with any contingencies, any unexpected costs, and also have cash resources if you need to invest in any new product lines or equipment, particularly if the market is going to change. As we come out of lockdown, one of the discussions I've had with clients is there is an uncertainty about trends in their customers and how business is going to come back. And some customers have, for example, decided to create a plan around advertising and promotion because they feel that customers have forgotten about them and they need to raise their profile. Advertising costs and promotion costs are upfront costs, and again needs managing through to ensure that before the sales pick up, they're not going to have created any working capital problems. One of the key costs in all businesses are employment costs. This is a key fixed cost for most businesses, whether or not you sell your products or your services. Employment costs always need to be met, and too high an employment cost will have a very quick detrimental impact on businesses. Similarly, if you are recruiting and increasing your headcount, this will incur costs on not just the employment costs of employing the people. You may end up with recruitment costs, training costs, and other add-on costs like benefits and pension costs. These costs also need to be factored in and need to be budgeted for in terms of matching trends in your sales and cash inflow. If you over-recruit and you need to downsize, this will also impact on your costs because, again, going through a process of reducing headcount, redundancies, etc., will again absorb cash. Things to avoid, maybe stating the obvious, but late payers from your customers will obviously have a very quick detrimental impact on your cash flows. So you need to develop strategies around how to encourage your customers to pay your fee notes as quickly as possible or pay for your goods within the terms that you've agreed with them. Overtrading. Overtrading is a symptom in a way of success of a business. And you have a situation where if your growth is very fast, there is a gap between your funds coming back into the business from your activities and you having to ramp up production costs or employment costs incurred to achieve that turnover. I was having a discussion with a client last week who's an online trader, an exclusive online trader, and they were actually quite successful pre-COVID. What they actually discovered during COVID was their trend in their sales was far exceeding their expectations, and they almost doubled their turnover over the next 6-month period. Now, this resulted in them having to recruit more staff, take on more storage space, and lay out costs for logistics. The end result of this was, even though their turnover had significantly increased, they discovered that actually their profitability had reduced and their cash flow was actually under a certain amount of pressure because they had not factored in the additional fixed costs around increased in turnover. So all businesses, when they're on a growth path, need to manage their growth through their cash flow. Always keep an eye on unexpected internal factors which may impact on the business, and these can vary from introducing new working methods, new skills, or training required for your employees. Things that are a must: create accurate forecasting. The more accurate information you have, the more clear and concise decisions you can make regarding your business. If you have a project that you are considering, always test it on paper. do sensitivity analysis, do what-if scenarios to establish whether or not the project is going to be viable or generate any profits. Always seek advice. There are other factors such as tax breaks to consider. These may have a beneficial impact on new projects or new scenarios which you are considering. In addition to preparing accurate forecasts, always make sure they are sufficient in detail to give you the information that you need, that they allow you to drill down on various aspects of your business so that you can, again, focus on your key parts of your business and make the right decisions. One of the key tools for businesses is to have regular management information. Management information is typically prepared or provided via management accounts. These can be monthly, quarterly, or even 6 monthly. Whilst management accounts are based on historical information, they are useful to show trends and allow you to compare your current performance against budgets. Again, focusing in on any variances to identify any risks and make any decisions that you need to mitigate them. There has been in recent times a significant improvement in the accounting software programs available, which you are able to extract data in many forms and again provide information to your in-house teams or departments to be able to again make decisions about your businesses and the direction in which it's going. Always useful to have an independent advisor if you feel that you need outside expert help. Advisors will give you an unbiased view on your accounts or on your plans, and will give you insights which you may not otherwise have considered. Again, sometimes people looking from the outside in are able to provide more valuable information compared to people who are embedded in businesses and sometimes are sort of distracted by all the other events going on, and the challenges faced by the business. Management accounts, again, will provide information which you can collate and analyze the data and prepare KPIs. For example, gross profit margins. You can monitor the profitability on your sales or your services provided. Net profit. Again, are you overall making a profit, and is the business moving in the right direction? Other key KPIs that you can consider are debtors days, how quickly your customers are paying you, and whether there is any slippage in that, which will again allow you to focus on any debt collection. And similarly, if you have bank borrowings and there are covenants, you can monitor your covenants so that if you are heading to a situation where you may breach them, you can take action before you end up having to have a conversation with your lenders about any breaches that you may actually have incurred. Building a business is always very challenging, and you require an element of commitment, not just from the management, but from your team as well. And making the right decisions will mitigate the risk that you have within the business. Always ensure that you are managing your cash in the business, and if you need to have outside advice, always seek it, because making decisions early enough will make sure that you do not incur problems in the future. Cash flow forecasting is an element of managing your cash. Not many businesses actually undertake cash flow forecasting, but it is a very important factor when running a business. Businesses very often struggle, especially in difficult times, and COVID has actually highlighted this more than any other factor in the last few months. Whenever the economy takes a downturn, the first instinct of businesses is to conserve cash. They will stop spending. They will slow down payments to suppliers. They will not incur any expenditure if it's not absolutely necessary. The impact of this always is that there's a knock-on effect throughout the economy, and weak companies very quickly become impacted and start facing cash flow difficulties. To manage these risks, it is important to have a cash flow. It could be 30 days, 60 days, 90 days, or even annual cash flows. They don't need to be necessarily always very detailed. They can be rudimentary, just so that it allows you to have the basic information to manage the cash flow of the business over the coming quarter or the coming month, and highlight any deficiencies that may occur. Simple cash flow would look at the very minimum, your expected sales or income coming in, factor in your fixed costs such as employment costs, rent, rates, utilities that you know are going to have to be met at any given period, and look at what surplus or deficit arises. This can be an ongoing monitoring by the business and doesn't have to be a one-off exercise, or shouldn't be a one-off exercise. It should be an ongoing exercise. Some of the key benefits of forecasting is that it would help in the prediction of your sales performance. It would allow you to manage your production schedules if you are a manufacturer, the timing of imports and even possibly exports if you are reliant on goods coming into the business from outside of the country, and will again help ensure that any cash flow required to fund these items is going to be available as you need it. It would help estimate your costs and manage your spending expectations, especially if you are going to be incurring in capital expenditure, such as buying equipment or putting in new production lines. It will ensure that there is sufficient cash flow there to meet those requirements. Cash flows will also help with managing your cash coming in and coming out of the business, and will help, for example, if you're reliant on an overdraft, to ensure that your overdraft is managed, or you actually identify what is the correct level of the overdraft for the business. Overdrafts, by their very nature, are help with the working capital of the company. They're not fixed borrowings, and if you do not have enough facility, you will have obviously difficulties in your working capital requirements. Cash flows also highlight pressure points. For example, you have commitments to VAT or corporation tax, and building them into a cash flow will help you ensure that you make provisions to meet those kind of costs. One of the areas that cash flows can, again, and we will touch base on this again later on in the webinar, is your credit control. Typically, most businesses provide credit, if they're not retail, obviously, to their customers. Agreeing terms is not necessarily always translated into the timely payment of cash by customers, and having a cash flow forecast will help you to focus in on the terms that you actually offer your customers and whether they are actually suitable for your business. Cash flows, again, will help you identify successful services or product lines that you have, and again, maybe investment in those areas to enhance your services and product lines. Similarly, they will also help you identify unprofitable services or products that you have, which again will help you make a decision on whether or not you wish to discontinue these lines or invest in new products or new services in the future. Forecasting basically is one of the key tools to identify risks, allow you to make timely decisions, and to help mitigate any risk in the business. Key components of management, of budgets and preparing cash flows is forecasting your sales. The three elements that you may consider is estimating how much you expect to sell in the future, and this must take into account seasonality. For example, some businesses do a significant amount of trade around the Christmas period, but do very little business in the months of sort of January, February. Others are, maybe have a different seasonality to them, and you need to consider these aspects in when you compile your sales forecast. It's not always necessarily linear throughout the year. If you're going to be investing money in advertising and promotions or special events, this will also require you to consider the costs that you will incur upfront, and also the impact of these on the sales, and what your expectations are in terms of achieving those. If you're a business that works on contracts, then again, you need to consider what the timing of these new contracts are, and whether or not there is any element of retained work in there, which you would need to obviously put into your forecast to show the trends. Profit and loss forecasting. So your sales forecast will filter into your profit and loss forecast as well. So in addition to your sales, you will bring in all your costs associated with achieving your sales and give you an idea of what the profitability is expected from the business. Some of the key benefits of the forecasting is it helps the business to estimate what tax the business may become liable for, so that provisions can be made. It allows you to understand the costs of bringing new products online and the profitability of those products. It helps you to gain an indication of any loss-making products or any products that actually lead to a negative cash flow. Some products may not make significant profits, but still do make a contribution to the business. And whilst it's not profitable, they do cover fixed costs. But if you end up with a situation where it actually has a detrimental impact on your cash flow, then you probably need to be considering discontinuing those items. VAT costs there are two aspects around this. So if you're a business which are, for example, is not able to recover fully all of the VAT, then you need to make sure you factor VAT costs into the forecast and consider what VAT aspects you would. So let me start again. So then you need to consider irrecoverable VAT if that's relevant to your business, and if when you're compiling your forecast, VAT is a cost you would actually exclude from items which are fully recoverable for VAT purposes, either costs or for sales. Turning now to the credit control process, many businesses actually do not invest sufficient time in their credit control process, but it is one of the most important aspects of a business, as it has a very positive impact on a well-controlled process on the company's cash flow. Good cash flow allows sustainable working capital in the business and allows for funding of capital projects and for growth going forward. One of the things I touched on earlier was overtrading, where you have a fast-growing company which is not having sufficient cash flow to meet the growth. A good credit control process will help to manage the risks of overtrading for a business. Credit control, if managed internally, is a good idea. There are companies who will manage your credit control outside of your business, but for good customer relations, it's usually beneficial to the business if it is managed internally, where you have good knowledge of your customers, there's quicker feedback, and you can resolve your queries in relation to your customers much more quickly. A good credit control process will have a good timetable of how your process is applied, and this can start from the date of the invoice is sent out to your customers, having a date when statements are issued to your customers as a reminder of outstanding debts, a follow-up procedure whereby you can actually contact your client before the due date to ensure that there are no queries, so that there's no excuse for not settling the amounts owed, a follow-up process if they are late in their payment, either by email or by phone. It is a good idea to build up a database on specific clients with notes to identify the key decision makers who are responsible for approving payments, identifying any queries that a customer may have, and making sure that these are resolved quickly. So again, there is no delay in the settlement of your invoices. So again, as I've just explained, you should have a clear process for chasing the payments. And again, this is unique to every business and maybe even to certain customer types. You need to invest time potentially in training your staff in how to chase your customers. Make sure that they're always courteous and make courtesy calls, and make sure that basically you are visible to your customers in terms of your debt collection. You can consider incentivizing your credit control department so that if they achieve certain targets, that they get some financial reward for making sure that their cash flow remains positive and debts remain as low as as possible within the business. Offering customers multiple payment options these days is a must. Most customers either pay online or via credit card. Very few now pay by checks, but still offering that facility would make sure that all options are available to your customers. As a worst case scenario, seek professional help. You may need to go down the debt recovery route, and again, having an outlet for this is useful. Customers who have no excuse not to pay usually wake up when they have a solicitor's letter, and any issues that they may have are brought to head very quickly. It is a worst case scenario. Obviously, it's got to be balanced with maintaining good customer relations. But if you don't seek support early enough, you may find a situation where your debts become bad. Again, seek advice on these aspects and ensure that you are monitoring your credit, your debtors, and ensure that you get paid in a timely manner. We turn now to pricing. Pricing is a very important aspect in terms of ensuring that businesses make profits and are successful. It is very easy to ignore pricing or be reactive to pricing and not follow market trends. There are a few aspects to pricing to consider. You can have incentives. For example, you offer discounts or add-ons. If you order product A, you get product B for free, or you get a discount on product B. You offer flash sales, fairly common, especially on the internet. And this will hopefully, lead to a growth in your sales. Whichever scenario you are considering, always test it. Undertake sensitivity analysis. Do it in sort of a small bites to see what the reaction is of customers. You can offer price reductions and see whether that leads to an increase in turnover and an overall profitability. Conversely, you can actually instigate price increases to see how this impacts on customers. You may find that customers are not price sensitive, and they're happy to absorb any price increases. Even if you were to lose customers, it's not necessarily the case that profits will go down, because the number of customers you lose is compensated far more by the profitability that arises from increased prices. You can consider price matching. One of the things I've actually noticed over the COVID lockdown is that we're ordering our groceries online, and noticed on the Tesco ordering platform that very often a message will flash up that this is price matched to Aldi, implying that they are just as good a value as their main competitor or one of their main competitors. But at the same time, they are actually offering far more products online than Aldi is. And furthermore, they have a minimum order value, so that even though you may order value for money goods, you end up ordering other goods as well, which is much more profitable for them, to get to the minimum order level. Psychological pricing. Now, there is lots of theories on this and some research that suggest, quite a lot of research that suggests that having a price, for example, at £9.99 is always more attractive to customers than having a price of £10. And we see this in all sort of retail pricing in the shops and online. We see it quite often on the forecourt when we buy fuel. It's never a fixed penny. It's always at a 0.9 or a 0.5. And again, the psychological impact on motorists is that they tend to go to the forecourt, which is purportedly offering cheaper fuel. Where forecourts make up the difference is obviously that it entices motorists to spend at their shop when they come in to pay their fuel bill. So it's worth considering, and again, it will be dependent on your business, how, what psychological pricing is applicable to your various products or your services. Whilst I touched on the price matching scenario with your customers, you must avoid price battles. You mustn't get into a situation where you are consistently reducing prices to capture turnover, because you may get to a point where your margins are so low that they are not able to cover your fixed costs, and you are actually trading at a loss. So you will have to consider a price point below which you cannot reduce your prices any further. Undertaking a forecast with a break-even analysis is usually is a good idea, because that will help you establish a sort of a price level below which it is not sustainable for the business to go any further. Consider adding some context to your pricing. For example, there are many suppliers, for example, Apple, which have a very good brand, high quality products, but they also offer, in addition to their sort of key products like the iPhones and the iPads, etc., many accessories, again sold at a premium, and services, again generating more income. So when you're considering your pricing model, always consider what add-on services you can provide, which complements the goods that you sell, or provide complementary goods, again, which add to the profitability of the business. Pricing for many businesses tends to, or can be, subjective. A subjective approach to pricing is based on guesstimates, past experience, and past trends. It can be hit and miss because it's not very accurate, and it tends to be reactive rather than proactive. An objective approach, on the other hand, involves much more analysis of costs, pricing trends, and budgets. Builds knowledge, builds a database of past trends, and is able to focus down to the profitability at a product level. So not all products are priced in the same way. Products are priced taking into account the markets that they are actually supplying. Taking the objective approach requires investment in time and strategies, but ultimately will probably prove to be much more profitable rather than just the subjective approach. Again, it is worth considering outside advice always in reviewing your pricing strategy to try and identify aspects which you may or may not have considered in your business. And good pricing will obviously lead to good cash flow and profitability. Turning now to business finance, this is obviously very much a key topic at these times. There are a lot of challenges around business finance in all times, particularly challenging in these times of the COVID pandemic. Business finance essentially is there to plug the gap from the point when the business is achieving its sales and income, and the timing of the cash flow from those customers to be able to meet its day-to-day cash expenses. I've touched on overtrading already in the webinar, and business finance is one of the ways that you can manage your growth and your funding of your capital investment. So business finance closes the gap in cash flow and can take many forms. Businesses need working capital funding. Typically, this is provided by overdrafts, shareholders' loans, and from the short-term financing you have from invoice discounting, as an example. Longer-term projects, such as the acquisition of properties or warehouse space, plant equipment, manufacturing lines, are typically covered by term loans. So these will be typically 5-10 years, have a fixed or a interest charge and a repayment plan over that period. The idea being that investment will generate a return from the business, which will match the term of the loan. Startup funding, companies need startup funding when they are in the first stage of getting the business off the ground. Companies will need to incur recruitment costs, for example, training costs, premises costs, buying stock and equipment, and funding can come in many forms. You can get, again, overdraft facilities from banks, even term loans, but you can have specialist venture capitalists investing in the business, or outside shareholders, especially if you are providing incentives through employment, a share incentive scheme, SCIS or EIS, and you can also seek funding from various crowdfunding providers as well. International trade finance tends to deal with imports and exports, foreign exchange management, and again, there are specialist companies or providers of that, but typically you would, in most cases, go to your bank, who will have experience in this and will help with the trade finance. There are many other alternative finance options available. You can consider asset financing. So if you're buying specific assets for your business, lenders will lend just on those assets and have a security specific to those assets. Typically, they tend to be sort of 3 to 5 year terms, and at the end of which you fully acquire those assets. I mentioned invoice discounting. There are again providers who you don't necessarily have to have an ongoing invoice discounting facilities. There are providers who will do one-off provisions of finance in this respect. Especially we have one large contract which you need to finance in the short term. One key thing to consider with financing is always consider diversifying your sources of finance. It's not always necessarily a good idea to have only one source of finance, because if you find that the business gets into some sort of difficulty, then it may not have access to any additional financing. So if you have an overdraft facility, but you are considering some sort of fixed asset expenditure, consider asset finance, because that won't put pressure on your overdraft and will allow you to have some sort of buffer to meet any contingencies that the business may face in the future. The government has provided, following the COVID pandemic, various sort of loan options for businesses to try and mitigate the problems that they've faced because of COVID. The Bounceback loan is one which has been well publicised. It actually stopped being available in March, and many businesses who took out the Bounceback loan back in May last year are now coming to the end of, or coming up to the first anniversary, and are facing the prospect of now repaying these loans. So the Chancellor announced back in September 2020 that companies or businesses that took out the Bounceback loans have some additional options available to them, and the initiative is the pay-as-you-grow option. This allows a pause in the payment of your Bounceback loan, make some interest-only payments, and also to extend the length of your loan to allow you to come out of lockdown or back into business in a more managed basis without causing you cash flow difficulties. The options around this will be provided if you have a Bounceback loan by your lender. They will approach you directly and give you the options available to you in terms of repaying this loan. Many businesses took out coronavirus business interruption loan, or CBIL as it's known. This loan, the conditions remain as before. Interest will be due beyond the first 12-month interest-free period. The guarantee from the government is obviously still there. If the business is unable to pay the loan back, you will now have to commit to regular capital repayments. If you are in the fortunate position that you're able to repay the loan early, there's no early repayment charges, and you can settle the loan earlier than the due date. The business obviously is still liable for the repayments, and the lenders will seek recourse to the business first before they call in on the government guarantee if the business is unable to meet the loan repayments. A further initiative announced by the Chancellor is the recovery loan scheme. So the recovery loan scheme is essentially there to provide support to businesses which have been impacted by COVID over the last year. It's available to any size of business, as long as the business is UK based. The business must at least have 50% of its activity derived from trading, and the funding must be required for it to recover and to grow from the pandemic situation. The key elements are the business will self-certify that they have been impacted by COVID. The loan will be available from various lenders. And you don't have to just approach your own bank. You can approach any other accredited lender. 80% of it will be guaranteed by the government. Ultimately, if you fail to repay the loan. Businesses will, however, be responsible for paying the lender's fees and obviously the interest going forward. The loan scheme covers various aspects of financing. It can cover overdrafts, invoice discounting, and typically this will be available over sort of the 3-year trading period of the business. It is also available for term loans. So a fixed short-term loan can be obtained, and this will have a maximum term of 6 years. There is no interest holiday in this loan, and interest will be payable from day one. One of the aspects of this loan is that lenders will undertake their due diligence on the viability of the business in terms of being able to afford the loan and the repayments. However, lenders have indicated or will consider excluding the short-term impact of COVID on businesses and will discount sort of the negative aspects of COVID on the business when they consider the giving the loan to the business. So if the business was sound and profitable before COVID, has found itself in difficulty, but the future forecast is that it will return to pre-COVID levels, then the fact that it has been making losses or has sort of some financial difficulties at present will be discounted or will be ignored by the lender when they consider offering this loan. Banks are also at liberty, if they consider that the business is sufficiently strong, to offer you a straightforward lending facility outside of this scheme, which may be worth considering if the business is seeking a longer term financing, spreading the cost over a longer period. That concludes the webinar, and I hope you found some of the points useful. I'm happy to take any questions if you have.
Okay, we have actually really overrun here, Paresh. There aren't any questions. Yeah, there aren't any questions for us at the moment. So what I would suggest, if anybody has got any questions that they'd like to put forward, please happily email Paresh directly. I'm sure that won't be a problem at all. And as I say, we will make an on-demand version of this available to everybody who's watched it. It'll be on the website later on today. So thanks very much, Paresh, much appreciated for the presentation. I hope everybody enjoyed it, and we look forward to our next one.
Thank you.